Okay, so is 3M a buy? Well, first of all, we'll see how it's doing, how it's growing, where are the weak and strong points of this company, and then we'll do evaluation and see is the current price a price for a buy or not. So the first thing we should check is how is the company growing, how they're investing their capital. So let's see, return on invested capital. Okay, so 10-year median return on invested capital is 19.8, which is really nice. Free cash flow, it's here. Oh, that's 10 years growth of 4.1. That is not very good. Now, insider trading. We'll see how many people that work in the company on important positions like directors, CEO, COO, and so on are buying or selling the stock right now. And in the last 6 months, there are no buys, just 2 sells. They're selling. That is a red flag. Well, not necessarily, because there are many reasons they can be selling, but nobody is buying, so that is not good. What about super investors? Well, we have here 6 super investors, but I don't see anyone from the top 5 that I follow, which is Warren Buffett, Charlie Munger, Lee Lu, Monish Pobrai, or Guy Spear. So we'll just put some here, some super investors. Okay, now let's get some financial info about this company. Free cash flow is 5,902,000,000. Long-term debt. Oh, it's big. Actually, they're buying back. They're paying the debt a bit from almost 18 billion. Now it's 16.56, but that is still a lot. So it's 16.56 million. That is a lot. It will take them almost 3 years to pay that debt with all the cash flow, all the free cash flow that they have. So that's not ideal. Okay, what about shares outstanding? We want to find out how many shares they have, and thanks to that we can see the value of the company. So it's 585 million. Where's the shares outstanding? 585. Okay, and we want to see how many shares they had 10 years ago, because that way we can see, are they buying back shares? If they're buying back, then our percentage of the company is going up, and if they're issuing new shares, then well, we're losing on that, right? So let's see, 10 years ago it was 703 million. That is nice, because yep, they for the last 10 years they bought almost 17% of their shares back. Okay, so let's look a bit at the PE. Current PE is 15. Let's see what was the average PE for the last 5 years for this company, for 3M. So it's here. Price to earnings 5 years 21.54. Now that is 54. That is nice, because what it means that compared to the average for the last 5 years, the PE is actually substantially lower. Let's also get 2 more important informations. First, revenue growth. And the revenue for the last 10 years, the growth was only 1.8%. So 1.8, and they have a dividend yield of 4.1, which is really good. That is a nice dividend. So 4.1%. Now, you see, if we use the method that you can read in One Apple Wall Street, if you have revenue growth plus dividend yield and you divide it by PE, you should try to find a number that is higher than 1 or even higher than 2, which would be great, that means that this growth is actually bigger than the price you're paying for. But in this case, in the case of 3M, it's only 0.39, which is really low. So that's a red flag there. Okay, so we have some of the most important data. We see they have a nice revenue on invested capital. The growth is really small. The debt is quite big. They're buying back shares, which is great. There are no insider tradings are buying, which is not good. Super investors, yeah, there's some. Dividend is really nice. And the growth compared to PE is quite poor. Okay, so there are a lot of red flags. I can only see 2 reasons that I would really consider buying this company. That's one is share buybacks, which is impressive, and the dividend, but the rest doesn't look that appealing. But let's see the valuation. What is the intrinsic value of the company? How much we should actually pay with a margin of safety to buy this and feel that it is a good investment. So we have to decide what will be the growth rate for the next 5 and then 10 years. Well, we can look at some data from here, and actually in all those areas, revenue, assets, free cash flow, earnings per share, it's from 1.8 to 5%. So, you know, let's say that the medium should be around, 3%. High, let's say they would go 4 and 4%, and very high, let's say they would go 5 and 4% later on. Low, okay, 3 and 2, and then 2 and 1%. Okay, so now we can see that this is the current price, 145, and the price, it's all red, as you can see. The intrinsic value for one share, the price should be around 97 to 127, somewhere there. It's 145, so we're still way off. And I'm using a big margin of safety, 30%. So with margin of safety, the actual price should be from around 68 to, well, almost 89. And we have an average here. Okay, so $78, $79, that's an average price with the margin of safety that I would consider buying this company. Right now, it's still lacking 46% to that. So it's all minus. So for me, this is not a buy. Of course, the dividend, that's really interesting. And the fact they're buying back shares and that they are a stable business. They don't have massive fluctuations, but I see too many red flags, and the growth is probably too slow for my liking, and certainly not with that price. So as always, remember, you have to do your own due diligence. You have to decide by yourself, is this a company for you or not? It's not for me, but this is just my opinion. But yeah, that's it for today. I hope it was helpful. If so, then please like this video and subscribe, and see you in the next one. Bye bye.